Welcome everybody to Volatility Trading Strategies. So if you did miss part 1 of this stock replacement strategy video, I'll leave a link so you can catch up. But just to recap, stock replacement is a method of using options to simulate a position in any index, stock, or ETF without actually holding the underlying asset. Now for most people, if you do have access to the underlying, say the SPY for the S&P 500, or VXX and SVXY for volatility products, likely you'll just stick to trading the ETFs directly. My conservative vol and the aggressive vol strategy both use the ETFs directly because they are so easy to buy and sell. But there are people out there who have been restricted from buying them. Maybe that's because your broker has placed limitations, or maybe Europeans facing some of the recent MiFID II regulations. Whatever the case may be, for some of you this may be a viable solution. So in today's part 2 video, I'm going to show you how to simulate a short volatility position using the stock replacement strategy and the VXX as our underlying vehicle. Before I get into any details today, I do want to stress that by far the most important aspect of any volatility strategy is knowing when to trade and when not to. Today's example is only going to be how to actually execute a trade, not the when or the why. The volatility markets are very complex, so nothing I say in this video is a recommendation to buy or sell anything. And of course, the example will also only have a one-day shelf life. Tomorrow, the markets may look entirely different, so we're just going to learn how to execute the trade when we do get those green light signals to take a position. So here we are inside the Thinkorswim platform from TD Ameritrade. Now it's not market hours right now, so I won't actually be executing anything. For that, I invite you to sign up for my newsletter, and if markets cooperate this week, we'll very likely be taking a trade similar to this one, so you can follow along in a paper trading account and see how it's done live. But this is a one-year chart of the VXX, which is the iPath S&P 500 VIX short-term futures ETN. Probably quite familiar to some of you watching this video. So let's assume that all the volatility metrics that I track day to day are signaling a green light for a short volatility position. So if we wanted to do that using the VXX, we'd have to borrow the shares from our broker and then short it. But that may not be viable for some people. Short selling, first of all, does have unlimited risk. There's also larger fees involved. You need the availability of the shares. You can have them called away from you. And shorting isn't allowed in many of the tax-sheltered account types. So shorting the VXX isn't a trade that everybody will want to do or even can do. But fortunately, we can simulate this position using a very simple option strategy called stock replacement. So first I'll click over to this Analyze tab to reveal the option string. This is everything that's available to us. Now recall from the previous video, I mentioned that I like to reduce the time decay value of the option by focusing a few months out in time. So instead of selecting this July, for example, which expires in 26 days and will have a significant amount of time decay, I'm going to choose this September, which expires in 89 days. This is a good first step to mitigate risk. And as a secondary precaution, I will rebalance the trade regularly if it is to be held open for extended periods of time. Now you can see the current price of the VXX is $33.06. Remember, one option contract controls 100 shares. So 100 shares at $33.06, the minimum capital required for this trade is only about $3,300, so it does scale to smaller account sizes. But for our example, to make the math more efficient, I'm going to use $50,000. A trader willing to risk $50,000 can short 1,512 shares. When we leave a little bit of space for the higher fees involved, it would be about 1,500 shares to short. But if we want to control the same amount of short shares using just the option, we can buy 15 contracts. 15 contracts is 1,500 shares controlled, so it's the same as the person just shorting the VXX outright. And since we also want to short the VXX, we'll be buying put options. Those are over here. If, for example, we wanted to go long the VXX, which is a long volatility position, we'd buy call options. But today we expect the VXX to go down, so we're buying put options. But which strike price to choose? There's a lot of them here. As I explained in part 1 of this video, I personally like to focus on around 0.7 delta options. This is the delta column right here, so 0.7 is right around that $50 strike price. This further reduces the risk because a 0.7 delta option will only move 70% of how much the underlying asset moves. Does everyone still remember the XIV? It was terminated earlier this year due to the massive volatility spike we saw on February 5th. Now, this VXX in our current example tracks with 1x leverage the front 2 months of the VIX futures. The old XIV tracked with 1x leverage, the inverse of the front 2 months of the VIX futures. Now, a rival product to the old XIV is the SVXY, which is still around. We still use it within the aggressive vol strategy ourselves. But it responded to the February volatility spike by reducing the 1x leverage factor to a 0.5x leverage factor. So essentially now, it is a 1/2 inverse product of the VXX. So in today's volatility environment, if you do buy the SVXY, that is essentially a 1/2 short position in the VXX. But our delta is 0.7 times, so our leverage factor is equivalent to a 0.7 VXX. That places our trade right about in the middle of the current 0.5 times SVXY and the old full 1x XIV and SVXY, which for many people is a good middle ground. So I want a 0.7 delta option here, but we also need a significant amount of open interest so that we can get an efficient buy price. And just eyeballing it, this $50 strike price is just about perfect for us. There's over $22 million in notational value here on that strike, and a delta of 0.69, which is good enough. So we can buy the September $50 puts. Now there's always a bid-ask spread here, but with decent volume, a rough mid-price would be around $18.83. So here's the trade. The current price of around $33. And we want the VXX to go down to make money, so this is our profit range over here. Now, another very important level of risk management here is we always scale the trade to what it would cost if we just straight up shorted the shares. Remember, options do have built-in leverage, so we could, if we wanted, buy more contracts for less capital. But we're not looking for a riskier trade here. We're just trying to simulate a position. So instead of spending our full $50,000 for the options, which would be equivalent to about 26 contracts, we're just going to keep the same 15 contracts, and the remaining money will just stay in cash. Our 15 contracts are the same as the short seller's 1,500 shares, with the only real difference being we have a 0.7 leverage factor because of the 0.7 delta. So 15 contracts. Now this trade will move at roughly 70% speed to a person who shorted the VXX outright. And that's in both directions. It'll capture about 70% of the upside and only realize about 70% of any downside. I like this because reducing losses is always more important than chasing big gains. And remember, this can also be done with a single contract, equivalent to about $3,300. Now it is less efficient with a smaller account because you can only buy full option contracts. Going from 1 to 2 doubles the required capital to $6,600. But just know that this trade can easily be done with a smaller account size. Now there's 2 other levels of risk management built into this trade worth mentioning as well. So imagine there was some kind of catastrophic event that made this past February 5th seem like child's play. October 1987 comes to mind. Anybody who is straight up short the VXX at say $33 like it is now, that's an unlimited loss trade. And however remote, it is always possible that in one single day, it, say, doubles to 66, or maybe even more. Shorting VXX directly could put you in a world of hurt in that scenario. But buying the $50 option contract, which only costs $1,900 per contract, no matter what happens, that is your maximum loss. Now, granted, losing half your capital in that event wouldn't be very much fun, but that is far better than having your potential loss be unlimited. Now, the other level of risk management built into this trade is that option is what's called Vega positive. Vega is the Greek symbol that represents the expected move of the option in relation to volatility. So imagine that horrible event did occur. No doubt it would be accompanied by a massive volatility spike, and the option buyer is going to benefit from that by having the value of their option increase. Now, it's not nearly going to offset the losses, but that Vega boost is going to provide additional insurance and further reduce that maximum loss. So let's recap the stock replacement strategy using VXX. When simulating short volatility, we use put options, and for long volatility, we use call options. Both sides of the trade are important because markets do move in both directions. To reduce that time decay factor called theta, we target about 3 months out. If conditions do hold and the trade remains active for extended periods of time, we will also rebalance by closing it out and opening a fresh new position further out in time. We also typically trade around 0.7 delta options, and we need to choose strikes with significant volume. Although options do require far less capital, we still reserve the full short position value to keep the trade the desired size and risk. This means that our max loss is capped at our reduced capital outlay, making it safer, and we are vega positive, which provides additional insurance during large volatility spikes. So this may be a complicated trade to understand at first, because it not only involves option trading, which is new to many, but it's also using a volatility product as the underlying asset, which again are very complicated instruments. But the actual execution of the trade, being just a single leg option contract, couldn't be simpler. So I definitely have confidence that everybody out there is going to be able to manage this without any issue. Like I said, you can follow along in a paper trading account and get all the practice you need before actually risking any capital. Now, of course, none of this talks about when to actually take the trades, and that, my friends, will have to remain my proprietary knowledge. But this trade is the base structure for the VTS tactical volatility strategy, rotating between short volatility, long volatility, and plenty of cash positions when the signals are ambiguous. So feel free to reach out anytime with your questions. I am always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.